This is a team prosperity training. This is a weekly training that takes place every Tuesday at 12 p.m. noon Eastern, 9 a.m. Pacific, and we go into different components of our business model as well as other things to help you get ahead in certain areas like professional development and growth. Before we get into today's training, real quick, I just want to review last week. Last week we actually taught and covered step two of our two-step process to convert debt to wealth. Remember, step two is taking the bank's position. That's how to become the bank and things like offset, wealth, arbitrage. We got some good feedback off that training. So what I'm going to do today is I'm going to go into step one, which is the front side of that. Why do we teach a two-step process to convert debt to wealth? Because that is a big problem in this country. People have too much debt and too little wealth. So what we do is we teach them a conversion process, simple and proven two-step process to convert that debt to wealth and change their financial trajectory going forward that puts them in the driver's seat instead of traditionally them just coasting in the back seat with the bank and the financial institutions driving. You guys always want to position yourselves as financial educators, financial coaches, whatever it is that you're comfortable, projecting into the marketplace. The reason that you want to do that is because we cover multiple parts of the financial plan. We're not in one lane. We have multiple ways that we can help somebody. And by doing this, when you introduce the other ways that you can potentially help them, it makes sense. So there's six building blocks to a financial plan. That's cash flow, debt management, emergency fund, proper protection, asset accumulation, and estate preservation. There's one other building block that kind of hovers above of these, and that's called financial education. So we're going to cover all of these as financial coaches, financial educators, but really we start with the debt management block. The reason that we do is because that's most people's biggest pressing issue to allow them that's holding them back from going forward. So when you guys look at this and when you're teaching this, don't make this complicated. It's a simple and proven two-step process to convert debt to wealth. Step one is we're going to eliminate the bank's profit. Bank makes way too much money off of us. So we're going to draw a line in the sand, not let the bank make so much money off of us. And that saved money, that canceled interest, those canceled payments can be used as seed money for things like assets, retirement, business, travel, whatever it is they're trying to do. So these can be used independently of each other. Somebody can concentrate on step one, somebody can concentrate on step two, or we can combine both of these together and use the same dollar to simultaneously cancel interest and earn interest. So today we're really going to concentrate on step one, which is eliminating the bank's profit. And we want to make sure that we are steadfast in our approach to the marketplace because you're not selling something that somebody may or may not need. You're getting in front of them with education that is absolutely imperative to change, like we were talking about just a minute ago, the financial trajectory of their money going forward. Most people that you encounter, if we take that Let's Make a Deal game show and we convert it into a financial version of Let's Make a Deal, most people either by default, what does that mean? That just means accepting whatever the bank puts in front of you without asking any questions, or maybe by operating with some bad or incorrect information. Most everybody that you talk to is going to door number one continuously over and over and over again. And by doing that, they're never able to uncover and take action on what's behind door number two and door number three. Guys, just in case that you have any question about this setup, let's look at door number one and really understand that door number one, when it's unveiled, is the bank's plan. This is not a prize. This is the most toxic and costly plan that you can ever imagine, designed to do two things: keep the bank rich, keep you poor. And either by default or operating with some bad or incorrect information, if we're going there continuously or our prospects are going there, they're never able to uncover what's behind door number two and three, which is how to eliminate that debt quickly and how to build wealth. So it's about unlocking the power of their cash flow, but also unlocking the power of what's behind these other doors and taking alternative actions and routes that put us in the driver's seat and give us control and peace of mind. Why is this important? Because the financial industry and their products are designed basically to profit from you. So when you look at this and you look at what we have here, this is a $300,000 mortgage at 4%. Now, are there 4% mortgages right now? Not really. But let's just take this at face value. Let's say mortgage rates do drop and we get back into the 4% range. This is a $300,000 mortgage at 4%. If we take door number one's approach and we do nothing, we stay with the bank's plan throughout the course of the years, you can see over here circled, that's the percentage of your payment that goes to interest. And you can see it starts close to 70. By year 15, it's under 50%, but barely at 48%. So what does that mean? Most of your payments, especially in the early part of the mortgage, are going to the bank's pocket and bottom line. It makes a difference over time, whether you stay in one house or whether you move around and change houses, move, upgrade, whatever you might call it. It gets worse and worse. It's a banking principle that's used against us. We're going to use the banking principles in reverse to help us instead of the bank, but systematically they're creating a way that benefits the financial industry. So when you look at interest accumulation, why is that a big deal? Because it's robbing people of their future. Let's say we have a principal loan amount of $200,000 and we have an interest rate of 6% and we have a mortgage payment of $11.99 per month and we have a mortgage term of 30 years or 360 months of payments. Most people say, this is how much the house costs, this is what my interest rate is, this is what my payment is, this is my term, I'm good, I'm signing off on all that paperwork at closing. What they don't realize is that interest rate is like a mirage because there's something called a total interest percentage, which is the actual interest that you'll pay over the life of this loan. And if, once again, in the example of using Let's Make a Deal, the financial version, if they go and do nothing, stick with door number one and just pay their payments continuously, they don't move, they don't refinance, they just see this throughout to the end of this loan, we have a big, big problem because the real cost of that $200,000 home is now $431,000 in change, which means, you guys, that 6% interest rate has equated into over 100% tip or total interest percentage. When you talk about paying $231,000 in interest on a $200,000 home, that sounds ridiculous to say out loud, and it is. And this is just one mortgage over 30 years. If you move, you refinance, do any of these things, resets the clock, more of that interest is building in the front years. How do we get to such an atrocious end of the line number? Well, it starts with the mortgage amortization schedule. And once your prospects understand the mortgage amortization schedule and you position yourself as someone who can help them maneuver through that in the shortest amount of distance and time, you probably won over a good amount of them. That $11.99 payment that we pay every single month in this example, it's going to be broken down between what goes to the principal and what goes to the interest. In month one, out of that $11.99 payment, $199 goes to principal, $1,000 goes to interest, which means 83% of month one went to nothing. It went to the bank's profit and their bottom line. But for you, the client here, if this was us, it means nothing. It means that only less than $200 of our $1,200 payment went to the actual loan that we owed and we borrowed on. What about in month two? Well, it doesn't get much better. There's a dollar flip-flop. Dollar more goes to principal, dollar less goes to interest. And then in year one, we're basically spinning our wheels. Look at what's happening in year one. We paid $14,000, over $14,000 in interest payments, and we've established an equity position of less than $2,500. Year five, 60 months into this mortgage, it's a good place marker, a good place to check the health of what's happening in this amortization schedule. For the bank, everything's going great. For the homeowner, not going so great because at the end of 5 years or 60 months, we paid $72,000 in mortgage payments. Of that $72,000, less than $14,000 actually went to the principal amount of the loan, which means $58,000 of the $72,000 that we actually paid went to nothing but pure interest or bank profit. And then if you get down to year 21, that's what we call the break even for this, because at year 21, we paid over $302,000 into the mortgage, and we've established basically an equity position on the principal balance paid of about $100,000. So over the course of the lifetime of a loan, they're created to make the bank and the financial institution very wealthy and keep you poor. If you move, if you refinance, if you do any of these things, you're starting this clock all over again, which makes it far worse in terms of the end numbers. You're halfway at this point at year 21, when you've only got technically 9 more years of payments left. How do we combat interest accumulation? Well, we use another banking principle to come and fight it. It's called interest cancellation. Once again, this is a $200,000 loan at a 6% interest rate, exactly what we've been looking at. In September, we paid $11.99. What went to principal? $199.10. What went to interest? $1,000. We already saw that on the last diagram. Let's say in September that after a financial education class with you, or for whatever reason, they're starting to understand how these are designed to rip us off, and they're going to draw a line in the sand, take a stand, and then start to create a shorter distance to the end result, which is a home free and clear. You can see out of the next 5 months, October, November, December, January, and February, the $11.99.10 payment is going to be continuous. This is what goes to principal. This is what goes to interest. Principal is the blue numbers. Interest is the red numbers. Now, what we're doing here is we're advancing principal. What does that mean? We're not worried about this payment. We're worried about what part of the payment actually goes to principal. If you add up those entire 5 months here, that's $1,010.54. It's less than one mortgage payment. So let's say in September, this person, let's say this was us, we got smart and we're starting to advance the principal because we have discretionary cash flow that can be put to work. Well, that $1,010.54 invested into the mortgage as advanced principal is going to do a couple of things. It's going to cancel out interest and cancel out payments from the back of the amortization schedule. Now, when October rolls around, do we still have a mortgage payment due? Of course we do. Is it going to be $11.99.10? Yes, it is. However, because we have paid these, it's canceling out the interest associated with it. The closed-end mortgage that we'll look in just a minute, when that payment comes due, the interest is due. If the payment is due before it comes due, it cancels out the interest. So just like you take money and invest it into an asset hoping to make a return, your money can do the same with debt. Whether you're earning interest or canceling interest, that's how your dollar works. So in this example, that $1,010.54 invested into advancing the principal of the mortgage has canceled out close to $5,000 in interest. So on the other side, if we have $1,000 we invested in, we have a 5-to-1 return and we make 5,000, it would seem like a good investment. Same thing on the debt elimination side, because now that $5,000 is no longer going to go to the bank. That can be seed money that can be rerouted into your financial plan for a number of different things that will have a positive impact on your financial plan. So once again, interest that we pay the bank, not the interest that you earn, but the interest you pay on the bank on your debt, is just another name for the bank's profit. So step one, we want to eliminate as much of the bank's profit as possible, reroute that back to you. We're not worried about the bank. They're going to be fine. We're worried about you. We're worried about our clients. We're worried about our prospects that we're talking to, trying to educate. So we're going to eliminate the bank's profit, reroute that back to you. Step two, that we talked about last week, we replace and become the bank. Whether you're talking about step one, step two, or a combination and doing these simultaneously, they're both perfect financial solutions for this economy. Step one, what are we doing? Getting rid of the burdens and liabilities early. We're getting rid of that 30-year mortgage in less than half the time. Sometimes the sweet spot is 5 to 7 years. What does that do? It eliminates up to 90% of the interest that you owe. My favorite part about all this, teaching it, is there's no changes to your budget or lifestyle or your loans. There's no refinance, modification, consolidation. We're maximizing cash flow. We're building significant reserves, and we're using technology that we use in every other facet of our life to get it done for us. So we don't have to invest time, energy, resources on a massive level and worry about making mistakes. Our main question to prospects and clients early on is, hey, if we were to cancel years of debt payments, where does that money go? What's the emotional trigger? Because what we're going to do from our side is the same. We're freeing up money, canceling interest, canceling payments, etc. But what is it they want to do? What is it they want? Because all we're doing is creating a legitimate path to actually help them get there. So once again, the banking principles are systematically designed to keep you poor and keep the banks rich. Everything from closed-end loan to interest accumulation that we looked at, mortgage amortization that we looked at, interest cancellation we looked at, the open-ended credit line, float and leverage, offset account, strategic debt payoff. You can use these banking principles just like the bank uses them, and you can reverse it on them and use their same banking principles to do what we're talking about. Cancel interest, cancel payments, save money, build significant cash reserves, and start to look at that money as seed money for assets. These right here, these three are crucial and imperative to step one: interest cancellation, offset account, and strategic debt payoff. In order to understand banking principles, we've gone through some of them, but what is a closed-end loan? This is more associated with like your mortgage. It requires at minimum a fully scheduled payment. There's no flexibility there. Allow payments in. Only money goes one way. It's a one-lane road. Only money goes in. There's no withdrawals or the ability to take money out. It's driven by a preset amortization schedule that's all lined up for you. Any money applied does not affect interest charges until the following month, and it calculates interest charges from month-end principal balance. Closed-end loans are set in stone. They're concrete. They're not flexible. So that's what you want to look at a closed-end loan. Now, on the other side is an open-ended credit line or loan. This is like a two-lane road. This is the ability to make multiple payments and withdrawals, money in, money out. It uses an interest factor to calculate interest, no amortization schedule. Money's applied today, affects the balance today, and calculates interest based on the daily balance. So can you use an open-ended credit line to pay down a closed-end loan? Yes, you can. And that's the HELOC strategy, right? Which is a line of credit strategy that we use sometimes when it makes sense for the client. So once you start to understand this and understand how to use these for your prospects and your clients' benefit instead of the bank, this becomes a lot of fun because the money game played in the right way, under the right set of rules, can be very beneficial to people, even if they don't make a lot of money. The offset account, this is going to be what, think about two bookends. On one bookend, you have the money that comes into your household for your income. On the other opposite side of the bookend, you have the money that's leaving for debt servicing obligations, your car loans, your student loans, your mortgage, your credit cards, all of those things. Right in the middle is what's called an offset account. And that's going to stand in the middle and pick off your debt, saving you time and money. Well, offset accounts can be many different things. This can be home equity lines of credit, we just talked about, personal lines, commercial lines, secured lines, unsecured lines, a whole bunch of different types of lines of credit. It could be as simple as something as simple as a credit card, a PayPal account, checking savings on a very basic level, and then some insurance products. What you need to understand is there's many different offsets, and the offset account can be placed into the equation for your clients in a meaningful way, depending on a number of variables, including what they have access to, and what makes sense to them. But we have additional education to make sure they're in the best offset, they understand all the offsets, and how that offset is going to work for them. Just real quick on a review, we covered this last week in part two, or step two of the two-step process, which is taking the bank's position. Just to reiterate, savings accounts, checking accounts, that's your own money. If life totally blows up, nobody's coming after you. If everything works out great and you use that as an offset, awesome. You've canceled payments, canceled interest, but you cannot create an asset from using checking savings to pay off your debt. Now, if you have a line of credit, let's say it's a HELOC. If something totally blows up, it's tied to the equity in your house. You had to have good credit to qualify. If you can't pay back, they're coming after you. It's a borrowed money. It's a loan. If they can't, they'll charge it off. The IRS will pick up where they left off. Now, the other spectrum, if you're successful using a line of credit as the offset account, great. You've done exactly that. You paid off your loans in a fraction of the time, canceled interest, canceled payments, freed up money. But once again, you cannot create an asset from becoming debt-free using a line of credit. The liquid insurance contract is how you cancel interest and earn interest with the same dollar. It's a non-recourse loan. We went through that last week. The policy is collateral. And yes, you can use this as an arbitrage contract to create an asset from becoming debt-free. So once again, you don't want to go into too much detail on the front end, understanding that we have extensive education and client help for the offsets. Step two, we talked about this last week, is learning the rules of the bank, is how to go from a more defensive position to a more offensive position, creating offset, arbitrage, and wealth creation using the rules of the bank. But if somebody has debts, especially debts like mortgage, student loans, credit cards, they got to do step one first, because you can't go out and manufacture the type of returns that the financial industry is making on you through your debt obligations. All we're trying to do, and what we're training today for you guys, and what you're training and educating your prospects on, is what we call bank smart. Banks are very good and they understand the concept of no stagnant money. Money's always in motion. There's an ebb and a flow to money. It's either flowing towards you or against you. Most people have money flowing against them. We reverse that cycle. Smart investors do what the banks do. Our clients do what the banks do. And it's about movement of money. You're moving the right amount of money at the right time from one account to the other and letting it sit for the right length of time. Now, on top of how they organize debt obligations, they also are very good at understanding that most Americans and most people don't put their money to work. What does that mean? It's just sitting in accounts doing nothing. So every single day at the close of business, the bank, on top of taking advantage of us on the debt, is going to sweep our checking and our savings accounts for all the clients, and they're going to use our money to earn interest for themselves while we sleep. Money doesn't sleep, you guys. It's 24/7, 365. If you're going to learn to bank like a bank, then you have to understand this, and you have to implement a plan of action and execution that has your money working for you and not against you. There's always options. Unfortunately, people do nothing, stay on the bank's plan. That's great for the bank, terrible for them. That's what they decide to do. That's unfortunate, but it's their prerogative. Try some of this on their own. What they have to understand is they have been doing it on their own up to this point. And if they continue doing it on their own, what do they think is going to happen? And then the smart thing is use combination of technology and coaching to make sure you've got the shortest distance and the right financial GPS instructions to get you there. When we do it on our own, what's missing? Well, think about it. We have personal commitments, professional commitments. Do you really want to go multiple times a week and stare at spreadsheets, do your own calculations, and figure out, is this really the right way? No one has a system to do it. No one has the time. It's complicated. It can be complex. There's no strategic payoff. You're just staring at raw numbers. The mistakes that you make will be extremely costly. So we have the answer. And the answer lies in just understanding how our lives have changed over the last number of years for the benefit of technology. Let's say that you were going to do it on your own. And let's say, just for conversational sake, that this is your debt load right here. You got to do two important things here. Number one, you've got to line these up 1 through 6. What is the most toxic and costly debt costing you the most? 1 through 6. Once you do that, you have to take each one of these amortization schedules and reroute that, creating the shortest distance or the most linear equation to the end point. That sounds difficult and hard. It is. What you don't have to worry about is doing any of this. If you use technology, use programs, let it map it out for you. It's the same reason that we stepped out of the financial conversation, because sometimes talking about money continuously kind of, doesn't allow somebody to see things clearly. So let's say that I'm in North Carolina right now. Let's say I was going to California. Well, I can follow the stars. I can use a compass. I can use a map. As this all sounds archaic, and it is, I'm going to use the GPS every single time. I've used it for years. I understand how it works. I know that it's going to get me to where it's going to get me to. And along the way, it's going to let me know, are there road closures, speed traps, wrecks along the way? So technology, you guys, is the answer. And when you implement technology in your financial plan, you don't have to spend so much time, you get better results. And it really is a sense of empowerment because you understand the game and how to play that game much, much easier. There are different people in different programs, different courses, a bunch of different stuff out there in terms of money. Dave Ramsey, Susie Orman, Snowball, Avalanche, all of these are people in programs that are talking about money and debt. What you have to realize is those people in those programs are what we call general. They're talking to thousands, if not millions of people. We concentrate on the individual or the household finances that we're directly coaching or working with at that point. So yes, 24/7 programs looking at what we owe, our debt terms, our interest rate, our payment details, all the normal things, but also it's looking at your income and expenses, your cash flow, because this is extremely important. Cash flow is a roller coaster. It goes up and down. You have more expenses, less expenses, more income, less income sometimes. If that's not integrated in a way that is flexible with your cash flow, you're setting yourself up for disaster. We know life happens. And when life happens, your program it's not going to get all emotional. You're just going to tell it, hey, I had dental work. I had this happen. I had that happen. I missed some time at work. And it's going to recalculate, give you the short-term instructions, but always be able to recalculate that most strategic mathematical solution to zero debt. The reason I love the program and a lot of people using the technology program love it is because it's easy. When I log into my program, it's going to show me the exact dollar amount, the exact date, the most efficient accounts, what to do. It's like I'm driving the car, it's giving me instructions on what to do. So this is extremely important. And when you understand the precision, that's nothing's going to get a better result, and the ease of use, it's a home run or a grand slam for your clients, you guys. Why does it matter? This is why it matters right here. Over here on the left-hand side, in the red, are clients that when they came to us, that was their total debt, their years to pay off if they do nothing, stay with the bank's plan. And that last column, total interest, is the amount of their hard-earned money that's going to go to the bank, not to service that loan, but just to make the bank more profitable. What were we able to accomplish for them? Over on the green side, you're seeing significant reduction in two of the most important parts of the financial equation, which is time and money. You can see 26 years down to 2.9, 32 under 10, almost 40 under 4. You can see significant time reduction. What does that mean? Well, at 2.9 years, we don't have another 20 plus years of payments left. Those payments are getting reinvested on top of the canceled interest. If we're going to pay the bank 85 and we can reduce it and reroute 73.5 back over to our plan, is that significant? Does that help out with retirement, asset accumulation? Somebody wants to start a business, travel, whatever it might be. This is not chump change, you guys. This is tremendous savings of years of payments and massive interest. And when you do that, it's a value-based proposition. Now you are tackling something that's a burden, that's a debt that they already have, that you're going to help them get rid of. And by doing that, you've inserted yourself as a person who can help them further with the financial plan, with the other things like asset accumulation, protection, estate preservation, whatever it might be. These are not the only three types of people, but these are the three types of people that I see that get the most advantage and the benefit and value from our coaching and the program. Number one, this is somebody burdened by debt. They just want to get rid of it as quickly as possible. Let's say somebody's got a few years left to retirement. They got 20 plus years left on the mortgage and they're crunching the numbers. They really don't see how this is going to be possible. Well, depending on what the numbers look like, if we can take them on as a client, if we can help them, we can take that type of person on and get them ready for retirement by decreasing the debt load, getting rid of the debt, which frees up the cash flow. There's three things that really hurt retirees. That's debt servicing, long-term care, and inflation. When you start to handle these for people, they get a much better and increased standard of living in their retirement. Number two, these are people that want to rapidly increase equity in their homes. So they can leverage that money into other investments. Not everyone wants to become 100% debt free. Some people just want to use that equity as leverage for additional assets, whether it be real estate, other assets. Once again, if the numbers check out, the reports check out, we can take that type of person on as a client. And then number three, these are people that want to learn how to convert debt to wealth. This is that simultaneous strategy of using the offset inserted into the process to create an asset from becoming debt free. These are not the only types of people, but these are the recurring types of people that I see get a lot of value from our coaching and our program. Really what you're trying to do is set up education. You're trying to give people information, replace bad information with good information. You're trying to get them to the point where they understand the possibilities. Now they want to see what their situation looks like. We back up free education with free reports, tell them exactly what's possible. And you can see here that, it's laid out everything. What our savings are, it's over $500,000 here plus 2 decades. So 2 decades plus over $500,000 in savings. That's going to get people's eyes open wider. That's going to get their ears open wider to look and listen to more of what you're saying. Because if you look over here, this person is paying $3,500 in interest alone. That's 75% of their monthly payment gone. And if you compare $3,500 in interest against their monthly base income of $8,450, they're paying a decent amount of their income to the bank. They're becoming a foot soldier for the bank. We have to stop that. Over the next 30 years, they're going to average, if they do nothing, which is an option they can take, $2,000 a month in interest. This person's having to manufacture $8.11 for every dollar of principal they pay down. That's an uphill battle. And it's going to be March 2044, 20 and a half years from now, before they would be paid halfway, and they would still owe the bank 270 some thousand dollars. We have everything broken down, amortization schedules, if they stick with the bank, if they come with the program, bouncing off or springboarding off the debt into asset accumulation. If the numbers look good, the only other question that they're probably going to have is, how does it work? That's why we go into a demo. So if you're doing an education and you're running savings reports and the prospect at this point is excited about their numbers, the only other thing you have to do is show them how the program works, show them how we're going to coach it and set it up for them. And you should have a client that not only is in a way better financial situation now and going forward, but now you have a client that you're probably going to be helped in other ways, and you're monetizing the front end of this conversation with debt technology sales. So I hope this helps you guys understand the power of what we do, how most of the time we get in front of somebody from the debt management block because we're going to help them get rid of something they already have that's become a burden before we help them get something they need as part of their financial plan.